Welcome to another video in the series Learnings from the Newspaper. In this video, we will look at the financial term profit after tax, which is also known as PAT. The graph shown here is that of L&T Finance Holdings, which was published in the Economic Times on October 27th, 2017. So we will use this as a reference to understand this term. So what is profit? Profit is nothing but the amount which you gain after deducting your cost from the revenue. Or in other words, revenue is the funds flowing in, so inflow of money, minus the cost, which is outflow of money, and this gives you profit. So let's say you buy a pen for rupees 3 and you sell it for rupees 5. So this is your cost and this is your revenue. So 5 minus 3, that is revenue minus your cost, will be 2 rupees, which is your profit. Now same concept goes for an organization. However, it is a little more complex in terms of the organization having to deal with excise duty, depreciation, tax, etc. However, conceptually, this is the concept of profit, and profit after tax is the amount of profit which you have remaining after you have paid the tax. So we'll go to that detail also, but first let's understand this graph. So as you can see in this graph, the x-axis, which is this one here, shows the time period in quarters. So Q1 for FY17, Q2 for FY17, Q3 and so on. And the y-axis shows the PAT, or profit after tax. So this amount is in crore rupees. So the graph is saying that in Q1 of FY17 the profit was 207 crore rupees, and gradually it has increased, and in the current quarter, that is Q2 FY18, it currently is 360 crore rupees. So if you compare the Q2 FY18 versus Q1 FY17, it is a 74% increase in profit after tax. So profit after tax is the money basically that the organization is making, and it can use either to invest further in the organization, that is, it can further buy property, further invest in new offices and so on, or it can also buy new organizations using this money. So the more profit after tax that an organization earns, the better that company is and the more secure future it has. Now let us look at a simple P&L statement, that is profit and loss statement, and we'll come to know how the PAT, or profit after tax, is calculated. So to explain the calculation of PAT, I have used the profit and loss statement published by Procter & Gamble on 15th November 2017 in the Economic Times. So in terms of the organizational profit and loss statement, profit after tax is the net amount earned by a business after deducting all expenses like interest, depreciation, and tax. This profit is the amount which can be fully retained by a company, and it can reuse this to invest in the business. If the organization decides to pay dividends, then it is paid to the shareholders from this amount. So the first line in the P&L is the revenue from operations. That is how much is the inward flow of money. So this is again in rupee lakhs. So the revenue is 65759, and then it has some other income which is not from operations. Could be some fixed deposits or other income that the organization has made. So that also added. Then the total income is 66113 lakh rupees. Now from this income we have to deduct the expenses or the costs to arrive at the profit. So serial number 4 lists all the expenses. Now the expenses are cost of raw and packing material. So it has purchased some raw material and packing material. Then purchase of stock in trade, changes in inventory of finished goods, work in progress and stock in trade, excise duty, employee benefit expenses, finance costs, depreciation expense, advertising and sales promotion expenses, and other expenses. So once we add all these expenses, we get the total expenses here. So we got the total income and we got the total expenses. So as we discussed earlier, income minus expense is profit. So we have 66113 lakh rupees as the revenue, and we have 48339 lakh rupees as the cost or expenses. So if we subtract the expenses from the revenue, we get 47771. So 17774 lakh rupees is the profit. So that is what we have here. 17774 lakh rupees is the profit. However, please note that this is profit before tax. So we have already considered depreciation, excise duty, etc. in the expenses. However, we have not paid the tax yet. And tax will be paid on the profit which the organization is making. So this is profit before tax. So now to get profit after tax, we have to deduct tax from this amount. So tax expenses, that is current tax and deferred tax, has been noted here, which comes to 6218. So 17774 minus 6218, and that should give us the PAT amount. So this comes to 11556, and this is your profit after tax. So this is the same amount here, profit after tax. So this is a simple P&L statement, and here we focused only on PAT, but you can definitely take any of the annual reports published by a listed company, and you can go through the details of how profit after tax is calculated for an organization.